Welcome to Brain Food Bytes. I'm Annette Nellen, professor at San Jose State and director of the Graduate Tax Program, and a presenter for Cal CPA Titans of Tax Update presentations. I'm going to talk about two items to think about for 2023. The first one is that the IRS released the inflation-adjusted amounts. It's in Notice 2022-38, and it covers about 60 items in the law that are adjusted annually for inflation, such as the tax rates, the adjustments based on the CPA, just to show, was a fair amount of inflation. If we look, for example, at the 37% rate bracket, where does it start for married filing joint? It's about almost 50,000 higher level than it was for 2022. The standard deduction for married filing joint went up $800 from 2021 to 2022. It went up $1,800 for 2023. It'll be $27,700. Also, the definition of small business is defined as one that has average annual gross receipts over the prior 3-year period of $25 million or less. Last year, that was inflation adjusted to $27 million. For 2023, it'll be $29 million. Also, the gift exclusion for 2023 will be $17,000, up from $16,000 in 2022. And the estate tax exemption for 2023 is up almost about $900,000. The IRS releases the inflation-adjusted amounts of retirement plans in a different document. That's Notice 2022-55 for the 2023 amounts. One notable one, 401k contribution limit for 2023 will be $22,500, up $2,000 from 2022. The Social Security Administration releases the inflation adjustment for the wage base limit, and for 2023, that'll be $160,200, up from $147,000 from 2022, and that's relevant for when contributions to FICA for both employees and self-employed is no longer required, but there is no cap for the Medicare tax. The final item, something relevant in talking to your clients in the filing season for their 2022 returns, ties to the CARES Act that was enacted in March 2020. You likely recall that one of the provisions in that to help individuals in the pandemic was that they could pull out up to $100,000 out of a retirement account if they did it before December 31st, 2020, and they would pick that up into income ratably over 3 years, 2020, 2021, and 2022. There was no 10% penalty on that, but they also had the ability to put that back into their plan. And the time frame for doing that is 3 years after they pulled the money out. So if they did pull the money out in 2020, that 3-year period to put it back in is going to fall sometime in 2023, depending on when they actually pulled it out. The key guidance here for that provision is Notice 2020-50, explaining when that 3-year period runs, and basically they're permitted at any time in the 3-year period beginning the day after the date they pulled the distribution out in 2020 to put the money back in. So certainly want to ask your clients, and you're talking about their 2022 compliance, what the exact date was they pulled it out. Remind them they can put the money back in if they're able to do so, which is a great idea, because otherwise they can't get the money back into the retirement account. And of course, that account there is for retirement. So a few things to be thinking about. Looking forward to 2023. Thank you.